Hi, good afternoon, everyone. Good morning, rather. We get to it. Afternoon. Good morning, everyone. We're starting off this session now. I think we've waited for everyone to join. As and when people join in, we'll keep adding more. And I'm excited to bring you this edition. Why? Because we believe that for the first time we're kind of in a situation where we kind of feel that we are looking at the change in the global shift, or the dynamics in the global shift is happening in real time. So this is something of probably a thing that happens in once in a century. uh, we would consider ourselves to be lucky enough to be living in that period where we can actually see global shifts happening across the world. So, given that, I think in investing, probably there has been never been a better time, but there has never been a difficult time as well. And while I speak all of this, let me just start sharing the screen, and I would ask if you can see the screen. Just give me a second. Today we're still calling this Goldilocks something nice. Why? Because look outside, things look really good. While there are some bit of cracks which are forming underneath. So while we are in a very good situation, there are certain parameters that we should watch at this point of time, and we'll continue monitoring them. Now, when I say that there are stuff, which are forming, there are cracks which are forming, do you sit out? Do you sit out in a market? No. Why? Because, what we are moving into is a world which is, obviously, we've told that number of times, we are moving into a world which is inflationary. Things are going to get more expensive as we move forward. And once things move forward, what we believe is that one of the real ways of getting returns is through the equity markets. Now, obviously, there has never been a perfect time to begin equity investing. There will always be something or the other, that would come up, and that's the whole, journey of an equity investor, or that's the journey of a investment. That's the journey of an investment. You cannot ever have everything aligning together, and that is why this is a portion which is Goldilocks on thin ice. Now, we calling this segment when bond markets don't buy rate cuts. Now we'll come to that. Why do we say that? Just before we begin, the mandatory disclaimer here: the securities, obviously, that we quote here are just for illustration purposes. There's no recommendation on that. Also, investment in security markets are subject to market risk. And again, there is no price target. We're not saying that we are invested into certain securities, or we're not invested into them. We're just giving you this for a knowledge perspective. Do consult an investment advisor before you move forward. Looking at last month, we started off, you know, we started the last month seeing that India and China were the ones lagging behind, and US was the one that was moving forward. At that point of time, if you've been a consistent, viewer of this particular webinar, we've always said that India looks like the place to be, because from a valuation perspective, both India and China are the places where valuation comfort lies a lot. US has started to look expensive. It still looks expensive. As we move forward, we'll come to that as well. But over the last month, we ended the last month saying that the tide is shifting towards the east, and we could see that in the last month that India was the outperformer when compared to China and US. If you look for further east, if you go to countries like South Korea and Japan, they've been on a tear. So that's where we think that the world power is kind of shifting from the west to the east. Although 1 month leader cannot be the cycle winner, or may not be the cycle winner, but we believe that India still has a lot of value, given that we've underperformed major equity markets from a longer term perspective, starting from 3 months, 6 months to a year. We've kind of underperformed everyone over the last 1 year. And that is where a lot of value comes across, at least when looking at India. The indicators, we've we look at three kind of indicators. One is the PMI, which is for us, which is the leading indicator. The GDP growth and inflation are lagging indicators. Um, for across the world, we've been seeing that indicators, at least in the forward-looking one, the PMI indicator have always stayed above 50. And since we started this series back in June, we've always seen that these forward indicators are above 50. An indicator above 50 is an expansionary zone. Below 50, the PMI number being the Purchasers Managers Index, that below 50 is generally a contraction zone. We are looking across a world which is expansionary. That is why I say that this is kind of a Goldilocks kind of a scenario. But there are a certain bit of things that we need to look at. Looking at each of these countries from individual lens, the forward-looking indicators for US have gone up, and the GDP growth. We all know that there was a government shutdown last month, so we don't have the GDP growth numbers yet. So these are GDP growth numbers as of last quarter. The last quarter, the US economy grew by 3.8%. However, we did get the inflation data, which came out. It was expected to be a little higher than 3%, but 3% is also higher than the reading last time around, which was of 2.8%. So inflation in US is kind of going up. When we look at UK, we've always, again, across the series, we've said that, they are one of the economies that is slight bit in trouble, wherein inflation is pretty high and GDP growth is not kicking in. So they have registered a lower GDP growth than the last time around that we were here. China, on the other hand, inflation is cooling down. GDP growth has been stagnant. However, the forward-looking for China are a little lower, given that there are a lot of things around trade. Again, as we move forward, there are a number of trade deals that are happening across. So forward-looking for them have come down lower, but still 52 is quite a high number. Japan, the market has been on a tear. Their decision to leave the yield curve control has kind of started paying off. The GDP growth has started coming in. However, with GDP growth and wage growth, obviously the repercussion to this is inflation. So higher the Japanese market or the Japanese economy is currently facing a higher inflation. And with that, obviously, Japan is increasing interest rates. So they're managing this act very beautifully. And that's where it is one of those countries that we covered in length, I think 2 months back, because that is one of the countries that we believe should continue doing well. Eurozone, again, similar to UK, is struggling in some bit of form. However, they've registered a better GDP growth this month, or the estimates have been better. They've been higher than last time around. The forward-looking also looks better, and inflation is still on the rise. Moving on to India, again, India has been one of those outstanding performing countries. We've been long India for, I think, the last 2-3 months now. Like we've changed our stance also over time, going from neutral to overweight, and it continues to look good to us. Although the PMI numbers, which were at one point of time in 65, and we said 65 was like a very, very large number, we would not have been able to sustain at 65 would be ridiculous, to say the least, because that's pretty high a number. We're coming back to kind of the numbers that we expect around 60 years, where the forward-looking indicators should start looking good. So we expect 60 to sustain here in India. And with that, we are the fastest growing economy in the world. And inflation-wise, we are kind of continuing to do well. We are down to 1.54%. However, given that we have got rate cuts across, like at least from the Fed, moving here, we would expect the central bank here in India, RBI, to do the same as well. And we think that inflation possibly at 1.54 is the cyclical low, to say. So the expectation here is that inflation starts kicking in. So that is why I began this presentation by saying that it is going to be an inflationary world. Things are going to get more expensive as we move forward. Sorry, yeah, is there a question?
Hey, one question.
Please.
The inflation numbers are So there, for India, it is down by 1.54%, or right now India is 1.54% inflation.
So India is at 1.54% inflation. It is not down by 1.54%. So we were, I think, last month we were at around 2%, and we've come down to 1.5%. And that means that, let's say, something which was 100 rupees last month now cost you 101.5.
Okay.
So yeah, that's how this
Thank
works.
you.
So
Thank you.
no worries, Ashok. Thank you so much. Okay, cool. So at this point of time, on 26th of October, US and China, Trump and Xi, kind of they met. They met across certain different areas. They met in Malaysia. They met in South Korea. And now they have kind of penned a supposedly trade deal. The kind of something that was triggering the market for quite a while. That it was something in limbo. We didn't know where they were going. They've signed this first settlement kind of a thing. This is an ongoing process. This is something that they said is a part of a series. So for this month we are here. So basically they have signed a 1-year truce between themselves, saying that tariffs will be reduced and there will be a pause on the rare earth metals and other export controls that China was putting up. In response, US has cut the fentanyl related tariffs. Fentanyl is basically a pain reducing drug. Uh, so that tariff has gone down from 20% to 10%. And in return, China will resume to buy US soybeans and allow the rare earth exports to flow by. There are still a lot of other issues that have remained unresolved. There is the chip part, which is the more important part, given that semiconductors are on a rise. They refuse to speak on Taiwan security. Again, I think where these are that um, you know China wants US to. So US current stance on Taiwan is basically they do not recognize um, you know Taiwan independence. China wants to change this statement to US opposes Taiwan independence, and that single word is where I think a lot of issues are going on. So this is at least like, just given that there are certain issues, there are some certain key issues that have remained unresolved. We are expecting that this to be a kind of a dial down, not an entire reset between the two major superpowers at this point of time. And I said that they said that this is the part of the series that will go on, and there are other future visits and annual reviews that they will end up doing to see where they are and how much they are kind of complying to each other. So that's like the biggest one in last month. Now, what we found out that across this year, and that is why the markets have remained very volatile across this year. I think Trump has come out with a number of tariff news announcements, and what we've done is that we've seen the change across in S&P over the last, like, from the date of the announcement. What was the change in one day? What was the change in 1 week, 1 month, and 3 months? Obviously, these are short-term indicators or short-term returns to look at. But given that, starting from the first one, which was back in on third, like the beginning of March, 3rd of March, where he started the announcement was basically putting tariffs on Mexico and Canada, which were of 25%. We see that the markets reacted down for a week, a month, a day, a month, a week, a month, and over the next 3 months, it was exactly where it started. Then came the bigger one, the one on 2nd April, the Liberation Day, a 10% baseline plus reciprocal tariffs across. Over time, we've seen that in the next 3 months, the markets have moved higher. However, this particular Liberation Day was met by higher US yields, and the bond market started being the adult in the room. And then that is where Trump came and said that, let's just put pause on tariffs for the next 90 days. That was on 9th of April. From there on, S&P has given around 26% returns over the next 3 months. The next announcement was basically the China and US 90-day truce, which happened in mid of May. 12th of May is when that news came out. Again, you see positive returns from S&P over the next, 1 day, 1 week, 1 month, and 3 month time frame. And then there was this Canada tariff and a threat to EU. All of those also resulted in a positive change in the 3 months for S&P. Now, the two things happened in October. On 10th of October, China said that they would reciprocate, like they would put on tariffs on rare earth, and then there was a reciprocal tariff from US. Within the 1 week, S&P moved down, and then China and US have signed a trade deal on 26th October, the first one of the thing, and that was a positive change for the thing. Now, wherever we see this, the thing that we've kind of brought out from this is that across the Liberation Day to tariff pause to 90-day truce, those were kind of something in the air, or those were kind of speculation. The news now that is that you've signed a trade deal. So I think the volatility that the market was expecting is over, and with that we would expect the market to be pricing this in. So there was an expectation of a full-blown kind of trade deal between China and US. They've come out with kind of just part one of that. The idea that is there is that possibly maybe we would see some bit of cool down in the US markets before we start looking at further upside. So we continue to see what the change is, but obviously the China US trade deal was met with, at least on that day, it was met with cheer on the markets. But something that is a speculation and has moved to a news, I think the markets will start pricing what they were expecting and what they got. And I think the market was expecting way much more than what they got in the first set of kind of the deal. Last map session, if you attended, we asked how precious are your metals, and just for transparency, LLama Research went long on gold in Jan 2024. We issued that on our LinkedIn channel. We went overweight on silver in October 2024, last year itself. Both the times we could figure out, Jan we could figure out that obviously the fiat currencies were kind of losing their charm, and in October when we went overweight on silver, we realized that maybe strategic metals or kind of silver, which is used in almost every electronic, was running in shortages. What we've done here is basically if anyone in the investment markets would have seen here basically a major bull run in gold just once in their life, and this was back in 1970s. And in 1970s, remember that Fed had kind of come, like then Fed and central bank and the government had kind of let go of the Bretton Woods system. The Bretton Woods system said that the dollar was pegged to the gold. However, they let that go in 1971. So the major move that we saw in gold basically started in 1970s. That move was, I think, around 10 years long. So you have a bull run in gold from 1970s to 1980s, and in that period, gold went up like almost 25 times. When we kind of look at this, when we compare the similar gold story to right now, so this gold bull run started at the start of the century, so started from 2000, and we expect this gold bull run to be around 30 odd years. So what we've done is we've compressed these 30 years to those 10 years, and then we see kind of a very, very striking resemblance in the gold story. Last month we did say that gold was looking expensive when we started looking at this, but some bit of correction was expected. If we were to marry the last gold bull run to this one, probably you could expect some bit of correction going into the next 6 odd months. But post that the targets on gold are pretty high. What we also think that the gold target would be this time around, which would be much bigger than the last one, because this time it is backed by it is backed by a fundamental change. The fundamental change being that central banks across the world have lost, or the reserve currency at this point of time is losing kind of its charm, and central banks are more comfortable buying gold as a reserve rather than the reserve currency at this point of time, the reserve currency being the dollar. So we expect the gold prices to to or the move in gold to be much more higher than what we saw back in 1970s. For now, obviously, gold has lost its shine. So you've been, if what this is what we discussed last time around, we were expecting some bit of cool off. We don't think we've gotten like there is obviously some bit of cool off, but I don't think that this high is in place. Obviously, starting from this particular place. So again, if I were an investor who was caught in this, I would wait it out a bit. Obviously, the waiting time would be slightly longer than usual, but for now, if anyone's caught in this particular top, I would the suggestion would be that you hold on, because obviously the holding period will be longer, but somewhere around 4350 is where we gold kind of started retreating back. It was a massive move from and within kind of just 2 months, gold had kind of moved from $32.50 to $42.50. That's like kind of a massive move when it comes to a currency, or when it comes to an asset class which is used for hedging. So obviously the gold is currently not being used for hedging, but it's more of kind of a reserve that a lot of central banks are kind of holding on to. So and this entire move was basically because dollar has started losing value post the Zelensky meet and the tariff news. If you've been following again MAP for quite a bit of time, we've always discussed that dollar has been losing value. Dollar has finally found some stability below $100. It's around 98 to 99. Sorry, not $100, below the 100 level. So DXY is now below 100. So it's at 98, 99. So that's where it's finding some bit of stability. Any move when DXY below 100 without it testing 100 would have been like, again, something kind of ridiculous. So we expect the 100 and 101 to be tested. So some bit of stability in gold, in dollar is what is pulling gold down. But once again, when dollar starts to lose value, when dollar starts to kind of, start going down, that is when the next run in gold would start beginning up. Technicals had become too hot at 42.50. That is where we thought that technicals could start correcting, like the gold could start correcting. Now the question here is that can this 43.50 high be taken out? And again, a lot of us are asking that kind of question, that can this be taken out? My assumption is that whatever I've seen here and whatever I've understood from history, I think for a technical or for some bit of time, this 43.50 could be taken out, or we could see higher prices above this. That is when that real FOMO will start. I think the mania that we saw in gold was kind of stuck. It was there. It was out there in social media. Everyone was talking about it. But mania is supposed to be slightly more manic than what it was right now. So I think 43.50 could be taken out in the near term. Around 4,500, 4,600 is where I would start becoming, gold would start looking a little expensive when we kind of start looking at this. So if you actually look at this particular chart, there is some bit of high left here, and then probably a cool down, a very small cool down, but still a cool down nonetheless. So again, if again you just caught here and just trying to get out again here, I think this chart at least tells us that that maybe some bit of upside is left before a small cool down, and then the higher the real buying, or a lot through in gold. Okay, so why do I think that this particular highs would be taken out? Obviously, there are, and these are the kind of cracks that were, or geopolitical cracks that are beginning to start under the surface. This is one of the deals that Russia has backed out from. They've broken an agreement with US, which is the Plutonium Management and Disposable Agreement Act. This was signed back in 2000, just post the Cold War. And the idea of this deal was, or basically this, what this deal said was that every year, both Russia and US would destroy 34 tons of weapon-grade plutonium each. And this is because, they want to reduce the warheads that these countries have. If you actually look at the number of nuclear warheads across countries, Russia and US have the highest ones, and highest by a mile. Like they have around 5,000 or 6,000 nuclear warheads, while the third one in the list would have around 1,000. So during the Cold War, a lot of nuclear heads were created by US and Russia, and they realized that this is a threat to both the countries, and hence in 2000 they signed this deal to reduce the amount of nuclear warheads that were there. In 2011 is when this was ratified. It took them 11 years to ratify this thing. And then in 2016, Russia kind of softly withdrew from it, citing a number of situations. And in 2025 now, in October, they've broken this agreement. They said that we are not going to destroy any nuclear warheads. Across from 2000 to 2025, how many nuclear warheads were destroyed or how much plutonium was reduced? Very less. So US, which was sitting at around 94 tons of plutonium at the beginning of the century, now has around 86 tons of plutonium. Russia, which was around at 180 tons of plutonium, now has almost similar amount of plutonium. So both of these countries haven't reduced their warheads over time. And now that both of them are not aligned together, Russia has decided to break off this agreement. We believe that this could lead to kind of some bit of more tension between the two economies. Another issue that's happening in geopolitical phase is kind of US has put warships on the coast of Venezuela. They started this warship engagement started back in July, August, citing that it was to control drug trafficking. From there on, the number of warships have increased, the kind of warships have increased. So this no more looks like something which is to stop drugs trafficking from Venezuela. It looks like US wants to bring out a regime change, and the regime change that is existing in currently Venezuela is something that US wants to change. Now, what is the investment implication of this? Venezuela's oil export has hit a 5-year high. So Venezuela at this point of time is exporting a lot more oil into the market. Something that the Middle East does not like, but still being a part of the OPEC plus, they've kind of they supply a lot of more oil than what they used to. Any issues in Venezuela would mean that higher oil prices in the future. So the largest importer of Venezuelan oil is again China. So again, any bit of conflict here could lead to again US and China being being locked horns again against each other. The country level impact here is basically that again oil prices. If this standoff, if the warship actually becomes aggressive in a way, then the country level impact is basically the oil price hike will happen across the world, and US may not be that impacted, but China and India both could face supply disruptions, and that means that they would want to source more oil from the Middle East. Oil exporting nations like the ones in the Middle East, Saudi Arabia, UAE, and Russia. Russia is under sanctions, just to remind everyone. They might be beneficiaries of a tighter supply, and the sectorial impact that we can understand from this is obviously that again there could be a shift in energies. So renewables and EVs could start looking at. Energy itself could start doing well. This could actually lead to a supply chain disruption. So logistics could start looking well. And given that it could mean that again large countries would be locked horns with each other, defense could start looking good as well. The negatives obviously are the ones which are autos and airlines. They currently use oil, so higher oil prices start affecting them. Chemicals use oil as their base material. So chemicals and fertilizers both use oil as their raw material. They could start getting affected if this particular, and again, this is a big if this particular standoff becomes aggressive. So this is something to look out for. Despite being blinded, and this is the last big news that happened in October, despite being blinded by data not being available, the US government was in a shutdown mode. They did not release certain data like the unemployment data or the labor market data was not released out. Inflation was released out. We wonder why, but still they were released out. In this now, the US central bank, the Federal Reserve, is faced with a dual problem. They've always said that they've said two things, that they have a dual mandate to maintain inflation, or for the country, and to sustain the labor market. Here, what we see now is that they're kind of the balance is kind of tilting. Till now, we saw a Fed that was trying to control inflation. So you saw in 2023-24, you saw that massive rate hike that happened, trying to bring down inflation. So inflation at the beginning of the year was at around 2.93%, but if you go to previous years, it was around 7-8%, where after that revenge consumption, inflation in US had gone quite high. So now they've been able to bring it down to at the beginning, till the time tariffs were announced, it was fairly under control. But now again, we've told you this, that in our webinar before, that the trend in US inflation is shifting. So the trend is now on the upside, and along with that, this time around they are faced with another problem, which is the labor market problem, that unemployment rates in US have started going up. So inflation, the target for US Fed is 2%. Right now, inflation is at 3%. It was trending lower, but it has started moving up. Unemployment and labor market have started to weaken out. Why we don't have the recent numbers? Because of the shutdown. What we do have is basically a large number of companies have started reducing their workforce. UPS being the largest one, and then a number of tech giants also have reduced. While tech giants may want to reduce their workforce, given that AI is taking out a lot of these junior workforces out of the picture. However, when companies like UPS, Nestle, Ford, they start to take out workforce which is more physical in nature, that means that there is a larger problem as such which is not being addressed to, and we could actually see unemployment rates being higher than what we've seen in the past. Our major go-to indicator for unemployment and recession, we had a question whether if US is entering a recession now. So basically, at this point of time, if the question is US is entering recession right now, then our go-to indicator for that has been the SAM rule. The SAM rule is a rule by Claudia Sam. She's an economist who worked previously with the government, and she brought out this rule which said that the average unemployment over the last 3 months, and when you compare it with the average unemployment over the last 1 year, if this difference moves above 0.5, then the economy has moved into a recession. Not moving into, it has moved into. Right at that point of time, it has moved into. The people who actually give out the recession indication, they do it around 8 to 9 months later, but SAM rule is kind of the early indicator to that. So the number to look out there is 0.5. A number beyond 0.5 would indicate that the country is into recession. Right now, the number, because we don't have the last unemployment data, we have the unemployment data prior to that. The number right now is 0.17. So it's still comfortably below 0.5. So we don't believe that US is in a recession right now. However, this number prior to 0.7 was at 0.1. So there the trend is also changing. So 0.1 to 0.17 is what we saw as of the last unemployment data. We don't have the latest one. When the latest one comes around, we'll be able to, in a better state, to do that. How fast can 0.17 move to 0.5? Obviously depends on the unemployment data, but on an average, whenever we've seen this in history, it has taken at least 5 months for that indicator to move from 0.17 to 0.5. So is US in a recession right now? No, it is not. GDP is growing at 3.8%. When does an economy become into recession? When they have 2 quarters of negative GDP growth. Their last quarter GDP growth was 3.8%. Their Q1 GDP growth was negative, but their last quarter was positive. So they could have slipped into recession last quarter. They did not. But going forward, if the GDP numbers start dropping down, and if SAM rule hits that 0.5, we'll be able to certainly say that maybe US has moved into recession, but not right now. We still expect, if that is a possibility, then that is some bit away, not right now. However, valuations in US are at an extreme level. We've seen Nasdaq 100 PE near 40 times. Um, if the country is not in a recession, at least the valuations look like to be in some bit of higher levels, maybe a kind of a bubble that is kind of forming. This is being like AI optimism across the world. Lower yields and liquidity have pushed this higher, but yields at that one point of time were around 4.8. Now yields are at around 4%. So all of that has led this higher. However, it's been a very concentrated rally. The rally has, driven basically just by 7 companies, and this is the concentration that is lifting the entire index up. Why does it feel like a bubble right now? Obviously, the growth expectations are unrealistic high. People who've actually been there around at the dot-com time, you would realize that anything with the dot-com was supposed to solve the next set of problems. Similarly, with AI, I think everyone's thinking that AI would probably solve the next bit of thing. The question is the tech real? Obviously, it is real. AI is supposed to change a lot of things going forward. The biggest one that we feel right now is the education sector. If we were to learn something back in our day, and if we were to start reading up on something, there would be a whole set of an encyclopedia, marked from A to Z, and then you will pull out the right letter out of there. You would reach a particular page, and then you would read on it. That reading would only be limited to that particular point of time, and that encyclopedia was then replaced by Wikipedia, which was the .com thing, right? Wikipedia led to and Wikipedia was then replaced by the Google search engine, where you could search a number of other things. On Google also, you could then visit websites like Quora or Reddit, where you could read what other people are also thinking on that particular problem. Now all that you need to do is open Perplexity and type in your question, and you get quite a good answer to it, and then you can ask a follow-up question as well. So obviously knowledge is right now required, but the one that is kind of leading the thing is that how curious you are around your knowledge. The more curious you are, the more the questions that you start asking, the more answers that you start getting. So imagine a world where you could just read about a topic, and then, if you had the curiosity, you had to go and open another book and take that out and probably, do a lot of effort. All of that is available at a click right now. So that's how learning is changing, and how AI is changing is basically we've been able to get newer materials through it. We are being able to do better diagnostic through it. We are able to find minerals through it. So all of that is leading to a change, but like, is the valuation worth it? Things which are in a wrapper on top of a GPT kind of a background, do they warrant such kind of valuations? Probably not. And the other thing is basically, if inflation were to go up, if yields start going up, then valuation and itself starts taking a hit. At 40 times, this kind of very higher valuation. We've seen S&P forward valuations above 23 lead to negative returns over the next 10 years. Right now, those numbers are around 25 times for S&P. Now, anything beyond 21, 22 leads to a negative return over the next 10 years. Again, we've shown this previously. I'll show this at a later stage as well. Let's bring this up right now itself. If Microsoft shares we were to see, and this is back in 2020, back in 2000, sorry. So this was at the peak of the .com bubble. All the computers that were coming out had Microsoft OS in it. If you remember, you had this Microsoft 2000, Microsoft 97, 2000, Microsoft XP that came out in 2002 as well. So every computer, at least in India, had an Microsoft OS into it. And the question then was, would computers change going forward? Change the world going forward? Would every place use a computer? Obviously, every place was to use a computer. Every PC, most of the PCs later on would have a Microsoft OS built into it. But value of Microsoft share back in 99, the peak was around $57. So it was $57. It took Microsoft around 16 years to beat. Did every PC, or did most of the PCs have a Microsoft OS? Yes, but was the valuation attractive back in 99? Probably not. A similar thing could happen now. Will AI change the world? It will. It will. But is the valuation warranted for it? Will everything change because of it? It will take time. So probably we are moving into that bubble territory. Will the bubble burst today, tomorrow, day after? Uh, it depends, right? We cannot be sure when exactly the bubble would be hit. But given that if you start seeing interest rates or the bond yield start moving up, possibly that's the time that you would start expecting valuations to correct out. So having said all of this, and we started this at the beginning of the year as well, we said that given all the geopolitical tensions, given everything else, we expected the year to be kind of a median year. Why? Because India had gone through a correction some bit last time, like last October to December. If you see at that point of time, there was a correction. That time there was a correction. So the expectation here was that it would be a median year. We've actually been in a median year, just been a little more volatile. We've not either taken off or fallen down anyway. So the expectation at the beginning of the year, every year we start at the beginning of the year, we start out with our annual outlook. In that outlook, we tell you that what kind of a year we expect, and we expected 2025 to be kind of a median year, and we've revolved around the median kind of year. Now, what we've done is we've extended the study to from December to January. Whenever post Diwali, we have been in a median year. Most of the times over the last 25 years, we've had a median year. The expectation has been that it continues to do that going forward. The larger outlier here is obviously your COVID crash, which happened after February. In March. If you see this particular line is basically the 2020 COVID crash. Apart from that, most of the time you always ended up kind of going slightly higher than where you were on Diwali. So we expect this numbers to be also following a similar path. Just that the lows have been lower and the highs have been higher. So we are in a volatile world. There is no denying the fact. But we continue to do this going forward, at least till the end of the financial year. So that's what we've extended the study to. And on the previous years, the median year has moved higher. We don't expect anything different right now. We continue to stay overweight in India. And that leads me to the next slide. We are currently overweight India. We continue to maintain that position. We believe that we are at a very good place, at least in terms of valuation wise. In India, we do like large caps and mid caps. Small caps is something that we are actually looking at this point of time. We would want to wait a little more clarity on it, and we'll look at it why we want a little more clarity on it. But however, they also start to look. They're also starting to look much better. Similarly, in valuation perspective, China looks really good. So we raised China from underweight to neutral a few months back. We continue being neutral on China. And we continue to be underweight in the in places where we think valuations are not making sense at this point of time for us. In terms of sectors, we continue to remain with the sectors that we were last time around. So last time around, we went higher on the consumption theme after the GST rollout. We increased our overweights in consumer durables, realty, staples. We've always across the year we've remained overweight on metals, infra, and public banks. We've also remained overweight on pharma, and across the year we've remained underweight on IT. So at the beginning of the year we said that IT looked like something not to be something that did not make sense to us back then. The valuations there have started looking attractive, and we will start looking at this sector. But at this point of time, it does not seem to be. We're finding much more opportunities in the consumption space rather than our IT space. So probably it is a sector that we start looking out in the future. But at this point of time, we maintain the underweight there. In terms of debt, we continue to hold a neutral thing. We don't think that at this point of time maybe the yields haven't bottomed out. So the yields and the prices have an inverse relation. If yields start going up, your prices of bonds start coming down. We don't think that the yields have bottomed out or they have turned around. Possibly there could be a lower possibility in yields going forward. So for that, we maintain a neutral one. However, given that if we are moving into an inflationary world, debt does not make sense in a portfolio. So that is why we control. We right now maintain a neutral stance to it. We not overly underweight or overweight across it. At the beginning of the year, as I said, that we start out with an annual outlook. In that annual outlook, we tell you where we think what are the sectors that we have looked at across the year, and these are the sectors that we looked at and that have worked well for us. We were much overweight on PSU banks ahead of private banks, so those have kind of returned better. We've always been very vocal about metals. We've been vocal about energy, and we've been vocal about being underweight on IT. So IT as a sector that we did not like at the beginning of the year is down around 17% in the year. That has worked well for us. PSU banks have worked well for us, and metals have worked well for us. So those are the sectors that we were overly weight there. Now we are shifting over to the consumption sector as well, given that GST rollout. We are coming out like we've gone overweight on consumption as well. Now this is where I say that we'll be waiting for a little more data on the small caps. These are the earnings till now. So in September, there have been 427 companies that have come out with earnings. This is still mid-evening yesterday. There were a few companies that have come out with earnings later in the night. We've not been able to capture that. But for till evening yesterday, 427 companies had come out with their earnings this quarter. Out of that, a few of these companies had generated positive sales and profit year on year, and quarter on quarter sales were basically positive for a few more. The problem that we are seeing here is basically in terms of small caps. Small caps around 167 companies came out with earnings. Out of that, if we were to compare, sales, profit, quarterly growth and year-on-year growth, at the end, only 71 kind of have maintained that. And this is possible only because that there are a number of companies that have come out with other income masking weak operations. When looking at sectors as well, the results that are coming out better are from the large cap funds, companies. So public sector, you would not never find a very small public sector bank, right? So there the results have been really good, and that is what are driving kind of large cap names. These numbers are much better than what we saw for the last quarter. So that is why we have started looking at small caps. We're just waiting for a little more data on kind of the companies that are coming out, and we'll kind of take a look at those when we go ahead. We asked for a few questions on the thing that we share, and this is a question that we kind of get repeatedly. So I think this makes sense. So the question is, how do we trade this market, because it's been so volatile? And this was our answer the last time around as well. When the person asked the question, we'd come out with this particular chart. We said that there was a small demand zone coming out, and this was when we were last time around here. So this is on 1st of October. 1st of October, we were basically around 24,800, and there was a demand zone around 24,350. We said that the supply zone was basically between 25,230 to 25,650. We'd also mentioned that the supply zone, because it was being hit repeatedly, was feeling lighter, and the froth had kind of reduced, and we were expecting the supply zone to be taken out. We also mentioned that there were macro tailwinds behind us to take out these supply zones. We were hitting into a low inflation zone and a 7.8 GDP. So again, the expectation was to kind of hold this demand zone and to take out this supply zone. This is where we've come now. So that supply zone has kind of gone away. We've moved up, we've entirely taken away that supply. Whenever we take out an entire supply, that in turn now becomes our demand zone. So what do we expect going forward? We expect to test this demand zone. Somewhere to the mid of these demand zones is where we again start demand to come up. And now our supply zone becomes the all-time high, which is where we expect some bit of resistance to come through. So that's how you can end up trading here. Basically look at where supply and demand is. The risk reward in terms of going positive on India look much better. You've got multiple demand zones below. You've just got one supply zone at the top. So even if in the worst case scenario, if something were to go wrong with the world, and then if this demand zone is taken out, you've got multiple supports on the downside to help you out in that. While on the upside, that is the all-time high that is remaining to be taken out. How are we allocated today? We've increased our equity positions. We've reduced some bit of gold. At least for our aggressive investors, we've reduced gold and silver way much more than what we were invested before. We've increased the equity allocation. We do maintain some bit of cash for tactical reasons. Obviously, in a volatile world, you kind of end up getting a number of tactical calls across time. But at this point of time, again, equity remains an over us, and we have some bit of cash to deploy for things. We've been asked to find an undervalued asset, and this is what we bought out last year as well. So this is something called a mean reversion investment strategy. So what we looked at was we were looked at certain ratios across the world. So basically looking at gold to oil, gold to silver, and Nasdaq to gold is what we covered in this report. The median of this ratio. So basically gold is generally 17 times more expensive than oil across history since 1988, since the last around 40 years. Gold has been 17 times more expensive than oil. Currently, gold is 62 times more expensive than oil. When you compare gold and silver, gold is supposed to be 71 times more expensive than oil than gold, more expensive than silver. Currently, gold is 82 times more expensive than silver. Nasdaq and gold, when we kind of see it, so Nasdaq is supposed to be 4 times more expensive than gold. Currently, Nasdaq is 6.5 times more expensive than gold. What we've added now is basically a gold to copper ratio as well. So median times, gold is supposed to be 402 times more expensive than copper. Currently, gold is around 783 times more expensive than copper. So basically, based on valuation, we've been asked to find an undervalued asset. So based on attraction, copper, oil look much more attractive than silver, gold, and Nasdaq. Now, again, here a caveat: will this play out just next month? Possibly not, but you have to give this time. A mean reversion investment strategy takes time to come around. But the general idea of mean reversion investment strategies is that valuations reach back to their mean over time. Things become normalized away from a volatile world. So if you were looking for undervalued assets, this covers, I think, questions around industrial assets. This covers questions around undervalued assets. Finally, in terms of performance, we get asked these performance based on Nifty. We've been outperforming Nifty by quite a fair bit of margin. While most of our strategies are invested in multi-assets, equity, gold, and debt. Given the recent run up in gold, at least our conservative portfolios have started underperforming gold, but one cannot be 100% invested into gold is something that has to come across. Also, we expect that equity to start performing for us going forward. So and gold too, as we mentioned across this particular webinar, that maybe gold could cool off some bit. It needs to cool off a bit, at least from the next few months perspective. There our performance, at least when measured in terms of gold, starts going up. But when measured in terms of equity, we kind of outperforming equity for quite a bit of time. We've been outperforming equity since the beginning of the time that we started investing into these portfolios. Now, again, here the caveat is that every investor for us is different. Everyone has a different risk profile. And past performance does not lead to future performance. So this has been our performance in the past. The outperformance versus Nifty has been there. So so take this with again, something that needs to be kept in mind, that past performance and future results may be different. However, given all of this, the world will remain volatile, but your allocation, so volatility, consider that to be the noise, allocation considered to be your voice, and based on both allocation and volatility, I would choose voice over noise any given day. So thank you. I think we at the end of this session, if there are questions, then I could take that up.
Thank you for this session. Very insightful.
Yeah.
So one question I wanted to ask. So in one of the last few slides, you talked about valuation attraction. So copper is much more attractive right now than oil, then silver, gold, and then Nasdaq, right? So for gold, so there are ETFs how you invest in them, right? So how do you
Right.
invest in copper? So do you buy companies that are in this that work with this metal, or there are like ETFs for that also?
Um, sure. Thank you, Ashil Bhai, for the question. So the way to invest in copper here, if you are here in India, then you can invest into copper miners. There are in terms of companies that are there. Uh, yeah. So in terms of companies that are there, the largest copper mine is with Hindustan Copper. 70% of Indian mines lie with Hindustan Copper. Again, caveat here that there is no recommendation on Hindustan Copper from LLama Research. It's just a fact that Hindustan Copper owns 70% of Indian copper mines. So that's there. There is no ETF that you can buy in on the Indian exchange that relates to performance of copper. The second way that you can kind of get access to copper is through the derivatives market. So copper futures are traded in India on the MCX exchange. That is one way that you can do it. If you want a global-based copper miner ETF, then one can do the LRS thing. So they can move their money outside India, and there are certain number of copper miner ETFs that are available on the Nasdaq exchange.
Okay, thank you.
Thank you, Ashil Bhai. I think Aman, you would raise your hand.
Thank you, Karun, for the session. Sorry, I was late. I'm in a
Uh,
very different time zone.
Thank you
That.
for joining from Canada, which is thank you so
Yeah,
much.
all the way. Thank you. Great presentation. I joined just at the time when you were explaining these ratios, gold and copper and all those things, and it
Sure.
intrigued me how you are considering rare earths and aluminium in that.
Okay.
Are you
Sure.
tracking that, or is there a way we are tracking it?
Sure. Good question. Thank you so much again for that question. The thing with the commodity cycle is that commodity cycle moves in phases. Across time, what the number of commodity cycles that I have gone ahead and read about and understood, the entire cycle moves in phases. So generally, you start with a rally in gold, uh, and then you move to a rally in silver, then you move to a rally into other metals, which are copper, aluminium, and rare earth metals, which are plutonium, etc. Palladium, and others. Then you move to a rally into fertilizers, and then you move to a rally into oil and gas, and finally you move into a rally into soft commodities. So that's how a commodity cycle generally has worked. We have witnessed kind of. Let me bring this out for you. Just give me a second. Why we consider this to be a commodity super cycle. If you've been with us for some bit longer, then I think you would understand that I'm kind of quite positive on the commodity cycle. So let me bring this out for you. Just give me a second.
While you're bringing in the presentation, I also want to understand what kind of weight do you want to give going forward, looking at how now gold has already played out. We're talking about copper, and also how much weight would you put into, say, copper versus aluminium and other aspects?
Right. Um, so this is basically US 10-year from the last 115 years. Now, why are we comparing US Treasury to commodity cycle? Because this is what we've realized, that each commodity cycle begins and ends with the US bond market. It is interesting and kind of something that we've looked at. So if you actually go back to 1910s, the US bond yield that we can cover from is 1930. So whenever we've been on a downtrend of US bonds, bond yields, so these are bond yields again. So yields and prices are oppositely related. When bond yields will fall, your bond prices will go up, and your bond yields will go up, then bond prices will fall. So from 1910 to 1945, we saw that bond yields were on a downtrend. And from 1945, we saw that for the next 35 years, bond yields were going up. And from 1990, we saw that bond yields started to fall down till 2020, and now the bond yields have started going up. So we realized that there was a 35-year kind of a cycle across, or 30 to 35-year cycle across the bond yield market. For 35 years, generally the bond yields fall, and then the next 35 years bond yields rise, and then the next 35 years bond yields fall, and possibly this next, we don't know, but possibly if this pattern were to follow, the next 35 years your bond yields should continue to do well. Now, when your bond yields fall down, that means that money is quite easily available, and when the money is easily available, what we want to do is we want to uh, while the money is easily available, we want to innovate products which do not which lead to faster kind of usage rather than more meaningful usage. When money is tightly available, you want to invest into innovations that last a longer term effect or have kind of more meaning to life rather than speed as such. So the larger innovations that happened in the last commodity era, which was like 1950 to 1985, this was the last commodity era for 35 years. Things like mining and oil drilling, space race, green revolution, and nuclear tech took place. So similar kind of, and when you look at, so what we have named is basically the time that that bond yield prices go up, we call that the commodity era, and when the bond yields fall down, we call that the technology era. So generally, when bond yields start going up again, you start calling that a commodity era. So we just at the beginning of a commodity era. We're not anywhere even close halfway through. If we were to repeat what happened last time around, generally the last time around when the commodity era began, it was led by oil because that was the major commodity at that point of time. This time around, we are looking at something moving away from mining and oil drilling to something which we look for is renewable energy. Now, when we start talking about renewable energy, that is when we start talking about things like your aluminium, your copper wires, glasses, all of that. We also start looking for chips. We also looking for semiconductors. So space race could similarly become your semiconductor race as well. So when we start looking at semiconductor race, then you start looking at the space race is being replaced by the semiconductor race, and in semiconductors you start looking at your rare earth metals. So given that we are at the very beginning stage of a commodity era, we are hardly like 5 years into it. The runway is quite long. So when somebody tells me that I select copper now, or do I look at copper like 10 months later or 15 months later, depend on how much you want to hold them. In short, because we just at the beginning. If this was a train ride, let's say from Mumbai to Delhi, then we've not even reached, I think, Vapi as well. So the whole point is that we just at beginning of a commodity era. So the runway is quite long. Now you want to buy copper now or copper 10 months later, how does that matter? Because the runway is quite large. How much should you allocate? Again, all the commodities are quite risky. They go through an entire cycle. So this 30-year is a larger cycle. Within this cycle, you will have mini cycles where different commodities will start, because at the end of the day, money is limited. So how do you kind of keep switching between those? They will have that mini cycle. So again, depends from certain area to area. So Aman, you have a follow-up? Go ahead.
I think I've got the answer, but I think it has also to do with, other than the cycles, what I think I rely more on the mean reversion aspect that you shared in today's slide.
Right.
That calls for a stronger.
Sure. So basically that's the thing, Aman, that and within the cycle, how do you allocate between them? You look at what is more expensive and what has gone up right now, and what is the next one that looks kind of undervalued at that point of time. So that's how you you've got to rotate money around, because that's the world we are in. We are in kind of a volatile world. We are in an ambiguous world. So basically that's how, and although printing of money happens every day, but still that money is kind of at least with hand in hand it's limited. So you got to rotate around different commodities at a particular point of time.
Okay, thank you.
Prashanth, you had a question?
Yes, I don't have any.
I have put my question on the chat. Can you?
Okay, sure. Yeah, I can read the question now. So, any view on global investing? They say Indian economy is just 4% of global, and so we need to invest in global markets too. Also, what percentage of the portfolio should be invested, if at all? Sure. So, definitely, there are. So the question is around global investing. Indian economy is around 4% of the global economy. That's fine. Obviously, as a global citizen, you should look for investing globally as well. There are certain opportunities available globally. So basically, Harshil Bhai had this question that how do we invest into copper miners if there is an ETF, or how that's not possible in India. So you go globally as well to look for other opportunities as well. So given that, I think obviously it makes sense to be invested. Given that, where do you invest in globally? There are certain opportunities available in terms of you can diversify country wise, you can diversify by sectors. Yeah, so basically at this point of time, if you were to just talk in terms of percentage, the largest portion is with US having more than 50% in that MSCI World Index. So but given that US is that expensive, do you want to invest in US equities at this point of time? Probably not. We are waiting out. You've seen that we are underweight US at this point of time. So yeah, at the point of time where US valuations start looking attractive, the kind of opportunities available in US, the kind of chip companies available in US, or maybe China, the kind of technology available there, probably the opportunities we can do. We like to take them. In terms of percentages, for anyone, I think a 10 to 15% allocation in the entire portfolio to a global investing makes a lot of sense.
Thanks. Just one question.
Go
We
ahead.
would not be able to find out which country or which pocket to invest in the global thing. So is it advisable to go through somebody who knows about it,
Sure,
like a fund manager?
we advise on global ones. So basically,
Mhm.
for our clients, we have certain US allocations done over time. So it is advisable to go through an advisor. It's advisable to go through an advisor for your investing in India as well.
Right.
But generally, the idea is that um, obviously we would love people to do their job, their day job, because that's what they love, and we love to look at markets. We kind of look at markets the whole day. So yeah, in terms of global advisory, there are certain feeder funds available in India through, if you want to do
Yeah.
it through mutual funds, or if you want to do it through a direct equity advice, we have a section that kind of caters to that as well. So happy to reach out to you and
Okay.
get to know that.
Thank you.
Thank you so much, Prashant bhai. Any other question that we could take? Cool. If there are none other, then thank you so much for joining. I hope this was insightful. Again, this is something that we are witnessing. Okay, Prashant bhai, you had a question. Thank you for those questions. Thank you for getting asked to look at those questions. Basically, again, as I said, that in this world, basically this is the world that is being curious around, and this is the world where curiosity will lead to a lot of answers. So given that we get these questions from you, it helps us be curious around and look at it from every lens possible. So thank you for bringing up these questions and filling up the form and giving us those questions also. So that helps us to go and research. Again, these are very interesting times in investing. We are seeing global shift in power happen in real time. Again, something that and with the cycle shifting from a technology era to a commodity era, it just is an exciting time to be investing. Obviously, will the world remain volatile? Yes, it would. But volatility is the cost to admission to a particular thing, and like to returns. And thank you so much for all those questions, and hope this session was interesting to you. Have a good weekend ahead, and we are available to answer questions anytime that you have. Thank you so much.